I've been banking power projects for about 20 years in Australia, initially on thermal and a slow start in the early 2000s on wind. But it's only really in the last 5 or 6 years that things have really ramped up with the high level of activity that we've particularly seen over the last couple of years. In my institution, we're one of the largest global lenders in project finance, usually in the top 3. And power has become, over the last decade, 40% of global project finance activity. Australia's typically 10%, and renewables is now at a level where it's half of the power project financing market. Over the last 6 years, I've worked on around 20 wind and solar projects in Australia, got them to financial close, and many of them are now coming into operation. Looking at the difference between storage and traditional, or what's become traditional renewable solar and wind, is primarily the fuel. With a solar farm and with a wind farm, there's a lot of good science and engineering that's been done. Reliable models exist now to have confidence in the annual energy production and the statistics around that. In terms of storage, your fuel is electricity you're purchasing on market, and that's much harder to forecast safely and reliably. We need to have a look at the relativity of the two markets. Ancillary services is a niche market. It's only a couple of $100 million a year, and it includes things like black start as well as frequency response. The energy market in the last year has probably been about $18 billion, so it dwarfs the ancillary services market. So for the level of storage we anticipate to come into the market over the next 20 years, it's going to have to derive most of its income in the energy market. The ancillary services market is only a small niche opportunity where some of the early players may be able to get a good position. Lenders are just bringing in the capital. The project promoters are coming up with the ideas of what projects to build and where to build them, and create the revenue models for them. Our ability to finance them comes down to the strength of the projects and the strength of the revenue streams that they're able to create. If they can get a high level of certainty about those revenues, then we can look at higher levels of leverage within reason and reduce the cost of capital of those projects. We've done exactly the same with the renewable sector to date, where highly contracted assets can achieve gearing in the 70 to 80% range, and that gives a more competitive cost of capital and a lower price of power to customers. Policymakers need to settle fairly early what the classification and role of storage is in the market. It's very clear with something like a hydro pump storage that it's a generator. It's become a little bit more confused what the role of a battery storage is. If, as we talked about earlier, that the bulk of the revenue is going to come from the arbitrage of energy, then they really are generators and should be treated that way. There are other views at the moment. Perhaps they could be treated as demand or as network devices. But the policy makers early on in market reform here very clearly set out that generators were to be segregated from the network businesses, and the networks weren't to invest in generation. Now we've got an opportunity here to clear the policy debate before people get too far down the path. What creates need for storage is the market opportunity, and it's having the difference between low prices and high prices for a sufficient portion of time that the storage devices can make money. The more rapid deployment of large-scale solar will lead to a lowering of prices in the middle of the day and creating the opportunity. So really the biggest driver for more investment in storage will be more investment in renewables, particularly solar.